If you had put $10,000 into Nvidia just 3 years ago, that investment would be worth well over $120,000 today. And if that same amount had gone into Palantir, the returns would be even more dramatic. Why did these companies perform so well? Because they were perfectly positioned in one of the fastest growing markets in history, artificial intelligence. However, Nvidia and Palantir are already widely known megacap companies. The real question for investors now is, where are the less obvious AI opportunities hiding? In this video, we're going to analyze 3 under-the-radar AI infrastructure stocks that most investors are not paying attention to yet. These include CoreWeave, Nebius, and Iron. More importantly, we'll break down their business models, their growth potential, their risks, and which one may offer the best investment opportunity right now. Let's begin by understanding what these companies actually have in common. The common theme: the rise of NeoCloud companies. CoreWeave, Nebius, and Iron all belong to a relatively new category of companies, often referred to as NeoCloud providers. Unlike traditional cloud platforms that were built primarily for CPUs and general computing tasks, NeoCloud companies specialize in GPU-heavy infrastructure designed specifically for AI workloads such as model training, fine-tuning, and inference at scale. Their customers generally fall into 3 main groups: AI research labs developing large models, enterprises integrating AI into products and workflows, and hyperscalers that need additional computing capacity. Each of these customers has different infrastructure needs. AI labs require massive parallel compute power. Enterprises prioritize low latency and high bandwidth for real-time AI applications. Meanwhile, hyperscalers care most about reliability and uptime. Traditional cloud giants like Amazon Web Services, Microsoft Azure, and Google Cloud were originally optimized for workloads like databases, web hosting, and enterprise software. Those systems are still essential, but they are not optimized for the extreme computational demands of modern AI models. This gap in infrastructure is exactly why NeoCloud companies exist. The market opportunity: massive growth ahead. The AI infrastructure market is expanding at an extraordinary pace. Estimates suggest the NeoCloud market could grow nearly 27 times over the next decade, potentially reaching a $1 trillion valuation by the mid-2030s. That implies a compound annual growth rate exceeding 50%, which is significantly faster than the historical growth of the S&P 500. To put this into perspective, traditional cloud computing is already a $1 trillion industry. AI is expected to represent roughly 20 to 30% of total cloud demand in the coming years. This means the global economy will require an enormous amount of computing power, and NeoCloud providers are positioning themselves to supply that demand. How their business models work. Despite their differences, CoreWeave, Nebius, and Iron operate in broadly similar ways. First, they invest heavily upfront in land, power infrastructure, GPUs, data centers, and networking systems. Because of this capital-intensive structure, these companies rely on financing through debt, equity, or partnerships to fund expansion before cash flows fully mature. As a result, they are sensitive to interest rates and overall market sentiment. Revenue is generated through recurring infrastructure rentals. Customers pay either hourly or through long-term contract to access GPU clusters and AI computing resources. Their profitability largely depends on GPU utilization rates, power efficiency, hardware costs, speed of capacity deployment, and pricing power against major cloud providers. Key risks investors must understand. Before evaluating growth potential, it's critical to acknowledge the risks. 1. Competition from hyperscalers. These companies indirectly compete with tech giants like Amazon, Microsoft, and Google, which are investing hundreds of billions of dollars into AI infrastructure. 2. Heavy dependence on Nvidia. All three companies rely heavily on Nvidia GPUs for the majority of their compute capacity. If supply constraints occur or Nvidia prioritizes hyperscalers, expansion timelines could be delayed. Customer concentration. Large contracts with companies like Microsoft and Meta represent a significant portion of future revenue for these firms. Physical infrastructure bottlenecks. Securing affordable power, land, and fiber connectivity at scale is extremely challenging and can slow growth. Because these companies are still relatively small compared to mega-cap tech firms, their stock prices can be highly volatile, but that volatility also comes with significant upside potential. CoreWeave, ticker symbol CRWV. CoreWeave operates dozens of AI-focused data centers across North America and Europe, housing over 250,000 Nvidia GPUs. The company also has access to substantial power capacity, including contracted gigawatts of energy dedicated to AI workloads. What makes CoreWeave particularly strong is its deep relationship with Nvidia. This partnership gives them several advantages: early access to next-generation GPUs, advanced networking hardware, and strategic financial backing. Financially, CoreWeave has shown explosive growth. Recent quarterly revenue surpassed $1 billion, with year-over-year growth exceeding 100%. Even more impressive is their massive revenue backlog, which has surged into tens of billions of dollars due to multi-year contracts with major clients like OpenAI, Microsoft, Meta, and Nvidia itself. In simple terms, CoreWeave is not just a customer of Nvidia, it is also a strategic launch platform and infrastructure partner. For growth investors, this combination of scale, partnerships, and backlog significantly reduces execution risk compared to smaller competitors. Nebius, ticker symbol NBIS, the sovereign AI cloud specialist. Nebius takes a different strategic approach by focusing on sovereign AI and highly regulated industries such as healthcare, financial services, and government sectors. These industries require strict compliance, data security, and governance when deploying AI systems. While Nebius currently generates less revenue than CoreWeave, its growth rate is significantly faster, with triple-digit year-over-year expansion in its core AI infrastructure segment. One of Nebius's biggest strengths is its full-stack AI cloud platform, including infrastructure management, high-speed storage, security and compliance tools, and AI training and inference systems. Additionally, Nebius has secured large multi-year infrastructure contracts with major tech companies, ensuring a strong backlog and predictable future revenue. From an investment perspective, Nebius resembles how Palantir initially targeted complex, high-trust industries before expanding commercially. That strategy could create a long-term competitive moat. Iron, ticker symbol IRN, the flexible, power-driven AI play. Iron is unique because it started as a Bitcoin mining company and is now transitioning into AI infrastructure. The company owns large renewable-powered data centers across North America and is repurposing that power capacity for AI workloads. Currently, Iron has deployed tens of thousands of Nvidia GPUs and holds nearly 3 gigawatts of contracted power capacity. What differentiates Iron from CoreWeave and Nebius is flexibility. If AI demand slows or deployment timelines shift, Iron can allocate power back to Bitcoin mining. This dual-use model helps maintain asset utilization. Recently, Iron secured a multi-billion-dollar AI infrastructure contract with Microsoft, which is expected to significantly increase recurring revenue once fully operational. Management is guiding towards massive GPU expansion and a sharp increase in AI-driven revenue over the next few years. For investors, this creates an interesting hybrid exposure: AI infrastructure growth, optional upside from Bitcoin-related operations. Which stock is the best investment right now? Now comes the key question: which of these three NeoCloud companies stands out the most? CoreWeave, best suited for investors seeking scale and reduced risk. It has the largest GPU fleet, strongest partnerships, and the deepest revenue backlog. Nebius, appealing for investors willing to accept higher volatility in exchange for potentially explosive growth, especially in regulated AI markets. Iron, in ideal investors who value flexibility and diversification thanks to its power infrastructure and dual exposure to AI and Bitcoin ecosystems. Final verdict, educational perspective. Personally, all three companies operate in one of the most critical layers of the AI ecosystem, infrastructure. Just as cloud computing became essential to the digital economy, AI infrastructure may become the backbone of the next technological era. If forced to choose based on scale and risk-adjusted growth, CoreWeave appears to be the most established leader. However, from a valuation and flexibility standpoint, Iron could be an underrated opportunity due to its massive power capacity and evolving AI contracts.
Meanwhile, Nebius offers a differentiated strategy by targeting sovereign and regulated AI sectors, which could become increasingly important as global data regulations tighten. Ultimately, the NeoCloud space is still in its early stages, and all three companies could benefit significantly from the long-term expansion of artificial intelligence infrastructure. And as always, the most important investment you can make is in your own knowledge and research before making any financial decisions.